The stock market has risen, we've all seen that. But why did it rise? Is anyone really asking that important question? Of course not. You can't really ask a question if your head is in the sand. Well, it turns out what had been disclosed earlier is still going on in March. This appears to be a big issue for this unsustainable artificial bull market created by central banks. If you listen closely, you can hear the pop. You came here for the truth, so let me unveil that for you. Today we are going to talk about that which the mainstream media doesn't want to touch. If investors are selling, who's buying? Yes, you heard me correctly. I just told you that investors are selling. I have fully documented what has been happening over the past few months, and if you want to see that specifically, I'm not going to go into it in depth. Go to the very end of this video. I will link to that video there. It explains it in full detail. But I want to touch on this point today, and you will understand exactly what's happening. You can see what has happened with the US stock markets. Clearly, since the end of December, they have done very, very well. There is no denying that whatsoever. But the question I have to ask is why? What is making them rise? Now, previously, as we have seen over the years, central bank intervention has been the primary reason why stocks have risen. We have extremely low interest rates, and that lacks incentive. If you're an investor, you're looking around, where am I going to put my money? You're not going to put it in your mattress because you know you're going to lose on the inflation. You're not going to put it in the bank because you're not going to get any return on it. You're not going to go out there and seek these low-level investments. You want some money. You want some return because your money is depreciating over time, and as a result, we need to find a way to seek the alpha, okay? And this has been pushing individuals into the stock market. With the creation of ETFs, people have been able to get into mutual fund type investments where they consider it to be diversified and so on. They do this, and then it is a very low fee. It's mixed in, it's traded like a stock. It's easy for people to get in. There's just one issue, and we'll talk more about that in a second. Buybacks and ETFs are moving the market as investors shy away from single stocks. Well, thank you to Bank of America for finally highlighting the issue that I have already discussed here on this channel, but we have some updated info. So thank you to Bank of America for your assistance today. US investors were net sellers. I'm going to get my highlighter out here. I just want to make sure everybody is clear about this. We're net sellers of US equities for the second straight week as single stock sales totaled $1.481 billion between Feb 25th and March 1st. The S&P 500 registered its 9th weekly gain in the 10 last weeks despite the outflow. How in the world can that be? Individuals are selling. They're not buying right now, and yet 9 out of 10 weeks the stock market rises, adding to its sharp gains this year and since the massive fourth quarter sell-off. So you got to figure there's something fishy going on. And now we know that buybacks are the primary reason. Let's go further into the issue. I'm going to break it all down. So let me move through this information as quick as I can. Stocks are riding high in 2019 thus far, but recent gains have mostly come through buybacks and inflows into ETFs, with individual equities being shunned. That's directly from the information that they're able to provide you with, and I also covered this in that other video that I referenced. Buybacks last week totaled more than $1.4 billion in a week and are now up 58% year over year, on pace for a record year. Now you have to understand this. Last year, 2018, there was over $1.1 trillion worth of stock buybacks. Imagine that. $1 trillion plus had moved into these stocks, not from outside the market, but from within. $1 trillion. We're talking about big money coming in a single year. ETFs saw inflows of $854 million last week, up from $168 million the previous week. So big time going into these ETFs, okay? Huge investments happening on that front. There is no doubt about it. Still, US investors were net sellers of US equities for the second straight week. In the last paragraph here, the fund flows show you that while we've had a solid recovery off the December 24th lows, the participation rate, both institutionally and by retail investors, has not been there. You're seeing this V-shaped recovery in markets, and yet positioning is still very light. Thank you for this absolutely incredible news. This explains what I have been talking about, what I have been documenting here on the channel, and lo and behold, we are given further information on top of all of that. I am so thankful that this data continues to pour in to support what we have known for these past few weeks. So I'm going to continue on and show you what has been causing the markets to rise in the first place. And of course, the global money supply. I have this data showing you here that we have the S&P matching entirely with what happens with the global monetary supply. Central banks around the world are responsible for what we have seen in the stock markets. That's very clear. Since March of 2009, that has been unequivocal. There's no denying that. Nobody with any sense is denying that information. The only denial comes from the fact that they don't believe that the market will fall. They don't believe that the central banks will not go ahead and print more money immediately. They simply won't allow it to fall. Well, let's talk about that. So what we have here, just a few months ago, October came in, November, December, many markets were actually down a lot more than 20%. So they were officially in a bear market. Now the S&P was just at the line and rescued right at that point of the 20%, but we saw a whole bunch of them. There were many stocks that were down 30%. I believe Goldman Sachs was down 40%. We saw many of them in just those few months coming down well into a bear market. The Fed didn't react, and in fact, the Fed didn't say that they would rescue them or they would do anything at all. They were not talking about that. At that point, right up until the last few days of December, the Federal Reserve was being pretty stern in what its policies were, that it was going to continue to increase interest rates, but at the last meeting in December of 2018, we saw the Fed basically saying, we're not going to do it 3 times next year, the rate increases, but 2 times is probably more likely, and the Fed balance sheet will continue to run off on autopilot. That's what they said, and then everything changed after that. Obviously, they had a little discussion with their friends around the world, and things changed very rapidly. This presumption that the central banks will be there to backstop the losses are not on your terms, it's on their terms. They decide. So I have to ask you the question. Here we have 2007, the housing crisis has begun, subprime is melting down, we are seeing certain stocks starting to fall, all the industries then are being affected, everything's starting to tumble. 2008, looking terrible, all these industries are doing bad, we saw some failures occurring. We saw this escalation of the crisis, and yet Federal Reserve hasn't printed any money. They continue on. It goes into the early part of January 2009, and we look further in, and then the market hits a bottom, March 2009. And then we have QE1. We have the TARP bailouts, and then the markets start to go higher. Why didn't they react in, let's say, late 2008? Why didn't they do so in mid 2008 or even before that? No, they waited all the way until it was completely chaotic and the markets, the investors, and even the mom and pops with their pension funds were begging for resolution. Not when it's down 20%, when it's down 50, 60, 70%, depending on where you're looking. That's when they start to react. And then they can have their easy as pie, their no contest in their actions. It's really smart. And then, of course, to touch on the ETFs, I do believe that what we are seeing with ETFs is fantastic. If you want to be buying into the market and you're really not sure what to get into, if you just want an investment that is passive, that you believe over a long period of time will in fact appreciate. There's just one issue. If you ever intend on selling, particularly if the market is falling tremendously, the chances of you doing it at the price you think you'll get is very low. And of course, it's fine on the way up. There's a lot of liquidity, but as stocks are moving down, and if you have these ETFs, it's not like many stocks that you have out there where you might have a concentration into a few. See, this is really what's happening today. We're seeing only a few stocks that are doing really well. At least that's what was happening throughout 2018. But today with ETFs, the concentration is something that they can't be avoided at this point, the way that things are looking. That means on the way out, there's no chance in you being able to sell at where you think so. But what would I know anyway? That's all for this video. If you found it informative, please give me a thumbs up, and give me a thumbs up. You're supporting this channel, so I do appreciate that very much. All you gotta do is click the like button. There's about 10% or less of the people watching these videos on a daily basis that click that like button. So please, all you gotta do is click the one button and you are supporting me. Thank you. If you want the financial education you were not taught in school, these two books have everything that you need. All you gotta do is go down to the link in the description. You'll be able to flip through the books, check it out if you like them. If you want the audiobook, that's available at themoneygps.com. If you want to see me fully break down exactly what's going on right now, the reasons why the stock market can rise, even though investors are selling, check out this video and I'll see you there.